Hi, this is Brian Resney, President of Resney Wealth Management, bringing you an important update about the economy and the investment markets, and also about your retirement and what you should be doing with your money, and often what you should not be doing with your money. So many investors today are sending us email questions, listening to our radio show at record numbers, and I just thought I'd bring up a few things right now that we're seeing just in this week's economic outlook and what we're looking for as we continue through the month of March. We're seeing a lot of still pressure, obviously, on the U.S. economy. The consumer is nowhere near what it was 5-6 years ago from the spending binge and the free credit cycle that we saw over the last 2 decades. I believe that's going to continue. I've made this comment repeatedly before about a slow economic recovery. In fact, this is probably, if not the slowest, one of the slowest in history in the United States for a recovery after recession. And most of that recovery was brought on by stimulus by the U.S. government. QE2 is going to end in June. I think there's better than a 50% likelihood that they'll do a QE3, if not right away, but sometime down the road, simply to keep the economy chugging along, which isn't necessarily a terrible thing, but it's not something that I would totally agree on either. I think what you're finding right now, though, is really you have to understand the risks involved with the ending of QE2, which essentially is going to be you're going to continue to see pressure on interest rates to rise. I believe that you need to make sure that you understand the income investments in your portfolio more than ever now. I've repeatedly warned on these over the last about 9 months to a year, and we had a confirmed sell signal in all long-term bond type investments, whether those are ETFs, exchange traded funds, mutual funds, or individual bonds, especially the low quality munis on the long end and the government securities on the long end in addition. These are going to pose the biggest risk to your portfolio and the biggest decline. 2 things: rates go up, bond values go down. You're now locked into lower rates as inflation goes up, and you can get higher rates down the road. So sometimes it's better to have a little bit shorter term maturity like we do in our client portfolios, or use floating rate funds, use preferreds, use other instruments to generate some income. And there's not a problem with taking some of your income off the growth part of your portfolio in addition. And I think that's going to be extremely important going forward. The way things worked 5 years ago or 10 years ago are certainly not going to be the way that the investment markets are going to perform or act today, especially going forward. I continue to look at China, although we own no positions really right now in China, simply because of our relative strength indicators. I still like China long term, but because it's been so weak in really the last 6 months and really on a downtrend, it kind of pops out of our portfolio and we bring it to the next higher relative strength asset class, which was really South Korea at the end of last year. I think China will continue to do well long term, but their economy is starting to show some signs of slowing. Nothing like the U.S., by the way, so don't get me wrong. China's not going to become, in my opinion, another U.S., really slow growth. They've got a long time to grow the economy, but what you're going to find is they had a huge ramp up over about a 2 to 3 year period where the stock or that economy really expanded. You're going to see a little bit of a slowdown. When that happens and they start to raise rates as they have, based upon their own inflation fears and things getting out of hand, it's going to temper their stock market, which you've seen that substantially underperform, especially small and mid-cap U.S. equity-based investments. So again, because of relative strength, we did exit out of that some time ago and really replace that with the South Korea. Now, our positions can change at any time, and we do monitor our positions closely. Our market trend indicators, which are long-term indicator, which tells us really the health of all investment sectors individually, whether those are bonds, real estate, equities, U.S. or domestic. I believe you as an investor need to understand that what we're seeing right now in the foundation of our MTIs or our long-term market trend indicators is, again, we've had confirmed sells about 3 months ago or more in long-term bond investments. If you would have listened to my videos and read our newsletter, or if you actually had a real money manager, that person would have adjusted your portfolio. If you're dealing with a so-called advisor or broker, remember, their job is not to manage your money. They may work for a big Wall Street firm. That doesn't mean they're a money manager. They're acting as a broker. We've had an overwhelming response to our article that is posted in our investor resource tab, 10 big mistakes investors need to avoid, and also our recent article in there that we put on the top, Confused. And what you have to understand is you need to make sure that you know what the relationship is of that so-called advisor, which most of these people are brokers, bank sales reps, or insurance agents selling investment products, and that's it. Their job is not to manage your money. So if you're doing it yourself and you've listened to my videos, I believe you've done probably a great job in protecting your portfolio and helping to increase profits. If you're dealing with one of these so-called advisors, it's really up to you to do your own research and make your market calls. That's not their job, and that's not what they're getting paid to do. So you got to make sure you really understand that. So again, if you own long-term bond positions, whether munis, which is my biggest suspect area, and long-term governments, those are areas you should be completely out of, in my opinion, because you have substantial risk in your portfolio from rising interest rate environment. Possible defaults in some of the munis, not widespread catastrophic, but there will be some of this coming down the pike, in my opinion. Again, you need to really look at the long-term trends of the different sectors you're in. The U.S. sectors right now are in a very positive uptrend. In fact, they're outperforming the emerging markets on a temporary basis. That could continue for some time, and we do monitor that closely. And we do have our biggest actual percentage allocation right now into U.S. based equities for that part of the portfolio, and primarily small and mid-cap equity-based investments, which, in my opinion, are going to be one of the lifebloods to outperformance over the long-term period of time. This is Brian Resney with the Resney Wealth Report. Make sure you do listen to my Sunday show from 10 to noon this Sunday throughout Florida. If you have a question about your portfolio, you can always send it to us through our website. All questions will be answered on the radio show only. And as always, if you are concerned about your money, if you'd like to call us about your portfolio, feel free to call us. We do manage larger portfolios of $500,000 and up. But one of the things that we are looking at, because of requests from a lot of our listeners, is we are looking at opening up our investment advisory services on a special platform for investors that have between $100,000 and $500,000. So if you're one of those investors that maybe don't meet our minimum, we can actually offer you our services. We're actually in the planning stages of this, but we'd like to know from you if it's something you would be interested in. So if your portfolio doesn't meet our current minimum of $500,000 on up, and you have between $100,000 and $500,000, contact our firm through either a phone call or an email and tell us that you would be interested in those services, because we are looking at planning those for you, and we want to know what kind of response we can expect from our listeners if they truly would have an interest in that type of platform for somebody who doesn't quite meet that minimum yet. This is Brian Resney with the Resney Wealth Report. Until Sunday, make sure you have yourself an extremely profitable day.